I was selling General Motors cars, so I was selling Chevettes, Citations, Omegas, Sierra, the Chevy Celebrity, Camaros, of course, yeah. And then, of course, Beretta and the Berlinetta. Oh, I had this idea years ago. And I said, I just looked at him and I said to him, nice execution. We might as well take responsibility for my first child. That night, I thought about my wife wearing your leather pants.
I don't know how many children I'm responsible for.
We were pitching OEMs on the proposition of selling your vehicles with the ability for the consumers who buy them, the ability to return it if something were to happen during their ownership. And, we were getting nowhere. The Lehman Brothers bank failure and, the global financial crisis, and markets were just like nosediving and the markets were tanking. And Hyundai came, they said, we're interested. And they had purchased all of General Motors' ad space, the NFL playoffs, which was the wild card game, top 15 or top 10 Google searches. Hyundai dealers had no communication before this, okay? They saw a commercial on and go like, holy shit, what idiot is underwriting that? They almost felt guilty about how successful the program was. Hire slow and fire fast. You don't mind if I drink wine during our show, right? Like, it's okay.
Well, you're Canadian, so that probably started around 11 this morning. I understand.
No, that's cannabis here.
Jeff Stearns, connected through cars. If they're bigwigs, we'll have them on the show. And yes, we'll talk about cars and everything else. Here he is now, Jeff Stearns.
Jeff Stearns, connected through cars, here with my good friend Vincent Beretta. And I'm excited for more reasons than just the cool name Beretta. First of all, let's be clear that his family was begun because of a dinner that I threw. We'll leave it at that. We'll see if he wants to address that or if he wants to edit it out. But now I'm going to read from some notes. Vince is an entrepreneur who started his business out of a rented apartment in Toronto 22 years ago and grew his business, achieving... Now, listen, are you ready for this? And I just asked Vince before this recording, we haven't converted the money to U.S. dollars, but at $900 million in retail sales, and I think even in Canadian dollars, that's still money. I think it still is. And not only that, it's still money, okay, but his idea was the backbone of the most successful automotive incentive program, I mean, I'm not kidding, of all time. And forgive me, I keep looking at my notes here, and nothing will ever come close, really, and nothing has ever touched it since. So we'll talk about the Hyundai Assurance program. I mean, that's going to be the story. And also, I'm interested in, but Vincent doesn't really seem to think it's as interesting. He also has a program called WALKAWay that if he would touch on it a little, I think that if you're a car buyer watching this, you should always ask your dealer for this by name. And I'm not kidding. It's a fabulous product. So, Vince, fill us in a little bit.
Well, 22 years ago, I was an insurance rep for creditor insurance companies in Canada. I became a little disgruntled with what I was doing. I thought there was a better approach. One day after having dinner with a client and a friend who mentioned he was had to take back a couple of cars from some really good clients who couldn't afford to make payments anymore on their car, and they certainly couldn't afford to get out of their car lease and loan because they had negative equity. And I hope everyone who's listening might know what negative equity is, but we can maybe talk about that in a second. And this fellow helped them out with their cars, took back the cars, and he said, look, I'm in the business of selling cars, not taking them back, but I can see that this is going to be a big problem. And as negative equity grew, and for those that don't know, negative equity is the difference between what you owe for your car and what your car is worth. And that amount is negative equity. And that amount, negative equity, has grown in the car business since the early 90s. And now in Canada, the average negative equity is about, I think, about $9,000 on any given car loan or lease at the time someone has one.
And Vince, if you don't mind, because not everyone's in the car business watching this, So would you say, and I don't know if it's an opinion or you have evidence to back it up, do you think or know that the negative equity has grown over time because of the length of time that people have been given to pay and or bringing in the negative equity from their trade-in and the bank adding that on to the new one?
Yeah, the practice is that we've gone from, what used to be, way back when I started selling cars in 1982, Jeff, I was 19. I was selling General Motors cars, so I was selling Chevettes, Citations, Omegas, the Sierra, the Chevy Celebrity, Camaros, of course, and then of course Beretta, the Beretta and the Berlinetta. So there was actually a car named after Beretta and a gun. So same spelling. So as car loans got longer and longer and longer, and banks loaned more and more money against a car, people found themselves, zero down, 0%, and people were financing extras, whether that be a warranty or all the additionals that they would add to a car. And cars depreciated faster than people paid them down. So that created a negative equity gap. And that's how gap insurance became popular. And basically WALKAWay is gap for humans. It's human gap. So it doesn't have to, it doesn't happen to your car. It happens to you personally, whether you lose your job, you get transferred out of the country, you lose your driver's license. We packaged 7 to 11 different reasons to use the product and made it no charge to the consumer. And we made car dealers, manufacturers, or financial institutions pay for the first 12 months of coverage. And consumers had the option to buy extended versions or extended and enhanced versions of the WALKAWay product. But the first proposition is a 12-month complimentary policy that's provided by your dealer, your financial institution, or in some cases, such as Hyundai, the OEM or the manufacturer. So that's basically the proposition that we did, so people can return their car and walk away with little or no cost. And that's WALKAWay in a nutshell.
Okay, so you said gap for humans. Let me just clarify what gap is. So when someone takes delivery of a new car or a new lease, especially on leasing, I believe the manufacturers or the lease companies include gap insurance now. It used to be a policy that you always needed to buy. But I would always have gap insurance if I'm either rolling a lot of negative equity or not making a good down payment onto a used car. And 100% of the time on a new car, you should have gap insurance. And what this means is if you leave the dealership 5 minutes later, 5 weeks later, 5 months later, the car is totaled, meaning wrecked, unrepairable, or stolen, unrecoverable. That's what we call a total. They want to pay only what it's worth, which might be $5,000 less than you owe, or it might be $15,000 less than you owe if you financed in tax, tag, title, maybe a little bit of negative equity from your last car. There's a very good chance. So now you have nothing, you have no car, and you owe money to pay off the car that's totaled. This is what gap insurance protects you against. Did I word that right, Vin?
Absolutely. That's 100%. And that's a big hole in the insurance world. You buy insurance to replace the value of the car at the time it's deemed a total loss. So that's exactly right, Jeff. It's a total loss scenario, and we simply do that. The car doesn't have to experience a total loss. Something has happened to you, the individual who's driving and paying for that car, and you've lost your job, and you can no longer afford to make payments. The best thing for you to be able to do is save your credit rating, return your car, and there's in Canada, it's about $1,000 of net dollars to the family income when you return your car. It's not only the car payment, but it's the insurance and all the other ancillary things that are attached to your car and your car payment. That is about $1,000 of net to a consumer, and I would imagine the number is about the same in the U.S. So having an extra $750 to $1,000 in your monthly cash flow can do a lot for a family who are in need, right?
Oh, well, Vince, I mean, selling cars my whole life, and I already know I'm not as good of a salesman as you because I never had to sell Chevettes, Cavaliers, et cetera, et cetera. So, I mean, you're a real salesperson. So you built value in one of those suckers. But I've had, in my 27 years in retail and my 9 years not in dealerships, but friends still knowing that I'm from the business, people coming to me with an issue in their life where they're like, I would just like to be able to give my car back. And they think that, maybe I give the dealer $1,000 or $2, they'll get me back out of it. And it really takes $5,000 or it really takes $10,000 to get them out of the thing. I couldn't imagine it being, and I'm not trying to make this into a commercial. I just couldn't imagine it not being a relief if something came up unexpected to be able to give it back. So unless you have anything else to add, you are the founder, you are the creator of this program, and it's actually hard to believe that it wasn't thought of already, to be honest.
Well, thank you. And I've heard that before. I had one guy come up to me at an NADA, and where we had a big booth at the NADA in 2005, I think, with our American licensee out of Dallas, Texas, Enterprise Financial Group, or EFG companies, who are still a partner of ours. And so we had a big display there, and some guy came up to me and he said, "Oh, I had this idea years ago." And I said, I just looked at him and I said to him, "Nice execution."
Poor guy. Probably, he was on the news standing out on the ledge on the 27th floor that night. Good for you.
Yeah. So speaking of NADA, if you want to get this covered off now, Jeff, we might as well take responsibility for my first child. Here we go. Ladies and gentlemen, Jeff Stearns.
I bought Vince and his gorgeous, tall, thin wife, Miranda. So we know he's a good salesman because he sold Chevettes, and we know he's a good salesman because of who he married. Not that he's not a handsome bastard and well-dressed bastard, but he did have dinner and drinks with me. And I don't know if we know factually, but I think in the range, we created a child that night or close. Is that right?
Yeah, and in Las Vegas, and her name is Nevada. And, Jeff, I just thought about, that night I thought about my wife wearing your leather pants.
That did it. I don't know how many children I'm responsible for from people seeing me in that advertisement. Now, this is the whole idea of this podcast.
We are connected by cars, but we're friends too.
Look, the whole idea of this podcast is we do have some familiarity. This is not some interview show where, oh God, I need some content, or oh God, I need to be known. This is not, some dry production deal, for example, like Jason Harris. Okay, we'll leave that alone. So look, Mick Jagger doesn't open for anybody. We already talked about it. So I'm glad that you were able to open with Jason Harris, but now you're in Carnegie Hall. So please talk to us about something that probably everybody who ever sits down with you at a dinner or a party wants to hear about, and that's this Hyundai. And folks, if you're tuning out, you're like, these guys are just grabbing ass. Lean in right now to hear the story of the Hyundai Assurance Plan.
So Hyundai was presented with WALKAWay, the proposition of WALKAWay, in March of 2008. And it didn't go anywhere. We had been knocking on doors. Jeff, we have presented to Chrysler in downtown Detroit. We pitched General Motors in downtown Detroit. We spoke to Ford. We were pitching OEMs on the proposition of selling a car or selling your vehicles with the ability for the consumers who buy them, the ability to return it if something were to happen during their ownership. And we were getting nowhere. So all of a sudden, we all know what happened in September of 2008 with the Lehman Brothers bank failure and, the global financial crisis. And so September happened and October happened and markets were just like nosediving and the news was all bad. The markets were tanking. No one was doing anything. And Hyundai came to EFG, who's our U.S. partner, who had presented WALKAWay to them. And they said, we're interested. We didn't really know how interested, but after the first week in November, we found out how interested. They were going to market, and they had purchased all of General Motors' ad space for the Super Bowl, Barack Obama's inauguration, Academy Awards, the NFL playoffs, which was the wild card game on January 2nd of 2009. And they were talking to us basically at the end of November. So They had a ton of motivation. I don't know what they paid for the ad space, maybe 20, 25, 30 cents on the dollar from General Motors at the time. And they had no plan B. We were their plan, and they were going to market. We signed the deal New Year's Eve at 5 p.m. local time, Eastern Standard Time, and the ads ran January 2nd. From the day they said go to the day the ad launched was 35 days.
That's not even to be believed.
That's like, it is insane, okay? Like, can you imagine dealing with a global manufacturer, and they have this program, and boom, like, this is what we're going with, Hyundai Assurance. We saw the first ads, and they were voiced over by Jeff Bridges, and you can go on YouTube and look at Hyundai Assurance commercials, 2009 and whatever. And the Jeff Bridges voice was, just so synonymous with Hyundai at the time.
Hyundai Assurance. Now finance or lease any new Hyundai. And if you lose your income in the next year, return it to us with no impact on your credit.
They just knocked the cover off the ball. People had the aha moment, that they said, like, they stopped and said, I remember hearing that ad for when I couldn't believe it. And they were just floored. And the blogosphere went crazy. Hyundai Assurance, I think, was in the top 15 or top 10 Google searches for the first 3 weeks of January. It was crazy. And it just made such an impact. National media picked it up. Every news story picked it up. It was unbelievable how much press Hyundai got for that deal.
For it fitting Hyundai, though, Vincent, you can pick back up. But where Hyundai was at, they weren't as hot as they are now, right?
Not at all. No.
I mean, they had some stigma at that moment.
Mm-hmm. They overcame that stigma very quickly. And people were saying, like, why isn't this being promoted by an American maker or American OEM? Like, where's Ford? Where's GM? Where's Chrysler? And people were, this is at a time when people were super insecure. And just to tell you how effective it was, and as you open up, the most effective automotive incentive in history, and you say it's probably never going to be, beaten or duplicated. And that's probably true because, you have to have the timing that Hyundai had as it relates to, the timing of introducing assurance when you're buying a car. I still think it's totally applicable to everyone's life today. Nothing's guaranteed, and being able to return your car and being able to return a purchase is the cornerstone of retail, right? Being able to return something is the way in which we should all be able to work, especially if I've bought and paid and taken a time balance loan to buy the product you sold me. Being able to return it when I come on hard times and I'm still paying for the vehicle that I bought from you is a pretty, attractive proposition, especially if I didn't pay for the policy. You gave it to me, and I can use it. So just tonight, just to think, Hyundai beat the market by 30%. Okay, in 2009.
Explain what that means if we don't know what beat the market by 30%.
The market in 2009 tanked. Okay, it dropped 22% in 2009. Hyundai beat the market or beat their year-over-year sales by 9%. So they are 8%. Sorry. So the market was down 22. They were up 8.
There you go. So 30% ahead of market. Got it. Makes sense.
So no incentive has ever had that effect since and probably never will, because the timing of the global financial crisis, of course, the lack of consumer confidence was rife. People still had to buy a car, but if you're going to buy a car during the global financial crisis and you can give it everyone was afraid of losing their job. Say, hey, it's relatively risk-free if I'm worried about my job. And Hyundai went to market with this, and they won Ad Age's Campaign of the Year. Joel Ewenick was director of marketing for Hyundai at the time and won all sorts of awards. Their brand equity went from, their brand recognition went from, somewhere in the 40s to, top 15. It was a stalwart moment for Hyundai in the U.S. market for sure.
Now, can we back up a little? Do you mind?
Yeah. Mm-hmm. Sure.
So I'm fascinated by the story. I mean, I just love hearing about a product and how it happened. And I mean, I love the story behind the story. But for you personally, so here you are. I mean, you've already got success with WALKAWay, but you'd been working on Hyundai to try to get them to take it as a manufacturer's program. Not exactly sure where you're at, nowhere near sure how hot they were on it, that they're going to hang like their whole company on it. So I'm assuming that it was like a big, exciting deal for you. Like you weren't worried about where your next meal was coming from, but this is a deal that you were really interested in. Like, man, I'd love to close that. Where were you emotionally when it went from the normal meeting after meeting after meeting to all of a sudden you got 5 minutes to execute this thing?
Well, you have to understand that this was through our a licensee relationship with EFG companies. We were somewhat in the background. The original call to Hyundai was made by EFG in March of 2008. The call was made in November to kind of say, hey, are you guys, like what's happening? And let's, so we got secondhand information, but it was, once the deal started to move, it was all hands on deck. We already had invested in a portal, a transactional web-based system to transact these insurance policies. We were able to customize a Hyundai assurance portal for 800 of their dealers, and all dealers in the United States. I think it was 780 dealers that we launched, like literally overnight. We created a Hyundai Assurance webpage, which was basically all of our doing, that we provided Hyundai with all of that material. Commercials were cut and created and cut. The whole thing was just, and we were working pretty much, day and night on that deal. The size of the deal, like the deal paperwork, was massive. We added, I think it was 11 pages of intellectual property protection to that particular deal to make sure that, we weren't giving away the farm as it relates to Hyundai's ability to knock us off. Not that they would do that, but I mean, it's a pretty common thing for people to replicate insurance products. But being that this was such a unique proposition, and for the listeners that are watching this, an insurance policy that has no age limitations, it has no pre-existing health exclusions, it has 7 different reasons to use it, and allows the customer to return a vehicle. We pioneered this whole concept, and we trademarked the word WALKAWay, and we copywrote our policy language so that we could keep our intellectual property ours and monetize it over time. And having Hyundai have the faith and trust in what we did was pretty spectacular. And Hyundai realized great gains. Of course, we realized, as did EFG, excellent opportunity there. And we can't be more thankful of the trust that Hyundai put in us at the time. And it certainly paid off for both parties and the consumers that used the policy. But I do have an interesting story as it relates to Hyundai. It's kind of funny. So January 2nd, the first commercials launched. Hyundai dealers had no communication before this. Okay, they saw a commercial on and go like, "Holy shit, what's that?" So I mean, there was no communication to Hyundai dealers. They didn't have time. Like boom, and you start selling cars and we had to basically launch dealers, train them, and it was all done digitally and electronically over our portal. And 2009, that's still it's still relatively new technology for some dealers in the car business, right?
A little clunky doing a portal in 09.
A little clunky, yeah. When I started in 2000, Jeff. Some car dealers didn't. I mean, we issued every policy from the day we started over the internet, and we were the first. I'm sure the first insurance portal in the automotive business to issue policies over the internet. And people we couldn't sign up some dealers because they didn't have the ability to go online. Like seriously, and people were using dot matrix printers. Like the F&I office was still. Using dot matrix printers with self-duplicating copies, and a laser printer in the business office was like, So anyway, back to the Hyundai deal. So we launched January 2nd, and our underwriter at that time was Great American, okay, out of Cincinnati. And yeah, fantastic story, fantastic success story of Carl Lidner Jr. and his two sons. But I think it was Carl Jr. and his son is Carl the third, Carl Lidner the third, and there's a Craig Lidner. I think it was still Carl Lidner Jr. at 90 years of age was watching the NFL playoffs, the wild card game on January 2nd. And he saw the first Hyundai Assurance ad, and he said, "What idiot is underwriting that?" And I think on Monday morning he found out it was him, and they canceled the program. They withdrew their underwriting. Like, they gave us 30 days notice, and that was in the agreement. They gave us 30 days notice.
So now you're shopping the underwriting.
Oh my God, are you kidding me? And this has happened to me twice in my career, right? Where we've had this absolute cancel of an underwriter during a national program. And I'll tell you the other one later. But so Carl Lidner goes, what idiot's underwriting that? He finds out it was himself. He pulls the plug. And this isn't really my problem. It is, but it's not. But more so EFG, Enterprise Financial Group out of Dallas, right? EFG companies. By the way, great F&I company. Can't speak highly enough about them. Anyway, so John Papanastis is the CEO of EFG, and he's got to scramble to find an underwriter to, keep this deal going. And he does. He scrambles and gets it done. And, unfortunately for Great American, it ended up being a very profitable program. It's unfortunate that, a knee jerk like that. But a lot of people thought the same thing when I first started. They thought, oh, you're going to get killed in your underwriting. I knew all the stats. I was the guy that did all the research for the product from day one. I think I knew my numbers pretty well, and it bore out correctly. I did 1/2 course of actuarial science in university and 1/2 course in stats. And if it wasn't for Tom, he helped me on a couple of exams by looking over his shoulder.
But you thought you were okay with the reasons that people return cars, even with the current economic climate. You thought that you would sell $1 more worth of premium than you'd have to pay back out, or however you do your math.
Yeah, well, the whole math in underwriting is frequency and severity. So how frequent you get a claim and how severe the claims are, and you add those, you put those two numbers together, and that's your base cost, and then you've got to figure out how much it costs to administer policies, pay claims, do all that sort of stuff. And nevertheless, Hyundai Assurance was a success. It was probably the most cost-effective, it was the most cost-effective incentive ever for a manufacturer. Like, there is a story that says that they almost felt guilty about how successful the program was versus how much they had to pay for it.
So when you talk about that to the non-car industry person, we might talk about the cost of acquisition or the cost of getting a body into the showroom or the cost of a sold car, and that might come down to just pure ad expense. It might come down to, does a rebate, $1,000 rebate, move the needle, or $1,000 rebate if you own one of our products, or we're going to conquest another brand, or how much a 0.9% APR costs them, and then how many more car deals it gives them, if it gives them any. Am I on track?
Yeah, and at the time, like 0%, cash on the hood, all that sort of thing. Hyundai knew it didn't matter how much money they put on the hood. People didn't have the confidence to buy; they weren't buying. So Hyundai said that themselves. It said, it doesn't matter how much money we're putting down. Like, if you don't have confidence to be able to pay for this car, doesn't matter.
So this cost, maybe you can't say the number, but this might have cost the manufacturer a few $100 a car deal to give them their first year of coverage free or something like that?
Less.
Okay. So that's freaking free to to increase your sales 8% when the market is down 22%.
22.
That's
the delta was 30% against market.
Yeah, I got it. That is massive. And we don't need to get into the whole whiteboard lesson about what 1 point of the automotive market is worth. I mean, like 1%.
Hyundai increased their market share, their market share. Okay, are you ready? 42%.
Yeah, folks, for whoever's listening to this, forget about having 42% market share, but to increase your market share 42%. So this means you currently have 2% of the market or 10% of the market, and that's between all the General Motors makes. That's Ford, Chevy, Toyota, Honda, everything.
Yeah, but I understand if you had 2% of market and you went to 3 or 2.8, that's 42%.
Right, but 1 point of market, if I'm not mistaken, I was talking to a retired General Motors senior executive. I think 1 point of market share equals like a plant.
Yeah.
Or at least a shift at a plant. I mean, it's not insignificant.
Yeah.
So amazing. I'll never wash these ears again being able to talk to Vince Beretta about this.
I still pinch myself sometimes. Like, did I really do that? Am I really responsible? You still have that imposter, kind of complex. Like, is that really me? Like, did I really do that?
A lot of CEOs have that, by the way. Like, when am I going to get found out that I'm not really what everyone thinks?
Yeah, well, I mean, it really did happen. I really did work day and night. I really did almost go broke. Thank God my business partner was a car dealer who held the paper on my leased car because I wasn't making payments. I thank my, landlords at the time for allowing me to, be late on rent when I was. I couldn't pay parking ticket. I drove my car to my office and I parked and I stayed there well past the parking permit, allowable, and I would get parking tickets. I couldn't pay my parking fines. I couldn't get my license sticker renewed because I couldn't afford to pay the parking tickets. I'd withdrawn all my RSP, like my personal savings and my what we call in Canada RRSP, which is kind of our retired registered savings plan, which we're incented to do. I literally was on fumes, and with the passion of providing people who bought cars with meaningful coverage to save them when their life went off the rails. 22 years later, to look back, it just goes to show you that it's not about profits, it's about people, and it's about creating value. And if you create value, the value will find you. And it's been such a great ride for not only me but all the people that have come along the way for that ride. And we've got a great staff today, and we all do good work today, and we continue to do so. So it's been an absolute pleasure to have worked in this way this long, and the only way in which I've been able to do that is making it about people first, and when you do that, profits follow.
Well, Vince, this is what I love. This is what I love about doing this show, because a lot of people, when they see someone in a successful position, they think that it just went from this easy thing to this easy thing to this easy thing. What I love to hear about is the dealer was a friend of mine. He let me be late or not pay my lease payments. My landlord was giving me a little bit of a break late. I couldn't pay my parking tickets. I mean, you took it right to the edge. You had a lot of faith. You were not hanging on, but you believed in what you were doing and were able to get it across the finish line. And you, of course, knew or thought that you had something, but you had no idea where you were going. And I love the story behind the story, that we don't always know where something's leading. So we kind of just have to, when we believe in something, we just have to keep pursuing it. And we never know what the universe will present. Have you learned any business lessons that you can talk about?
Yeah. Hire slow and fire fast. When you know you've made a mistake with someone you've hired, well, not know, but your gut will tell you, and a lot of times you'll convince yourselves otherwise. I think that you have to listen to that. So first and foremost, hire slow. Don't be in a rush to hire someone and just put a bum in a seat. Take your time, find the right person, right people. But when you have made a mistake, you'll know it and act fast, because culture will always beat strategy. You cannot execute strategy without a good culture, and it's about people. Our product WALKAWAY is about people, and companies are about people. Your strongest asset does not appear on your balance sheet, and it's your people. So number one, that would be my first. Number two.
Culture, I love it. Culture will be, I wrote it down. Culture will beat strategy. And, that doesn't sound cold to me. At first I thought, hire slow. Well, that makes sense. Don't make a rash decision. Make sure you get the right person in the position. Make sure that they're adding, not just can they do the job, but adding properly to the spirit of the culture, etc. But at first I thought, well, God, that could be interpreted as a little cold, rip the Band-Aid off fast if you're not feeling it with the person. But it reminds me, when I was a new sales manager of a salesperson in my dealership that I really liked a lot, and he was not performing. So eventually, probably 4 or 5 months beyond when I should have really done something, I sat him down and I said, we just have to part. I'm really sorry. I love you, Ron. He goes, I've been waiting for this for 3 or 4 months. I don't know what took you so long. But I actually subscribed to the fire fast because what I learned was he went off and started a commercial cleaning business, going into businesses and cleaning them at night. As a matter of fact, he got our dealership as a client. He ended up probably 5 or 6xing his income. He was on the golf course 4 or 5 days a week because he didn't work till nighttime. I bumped into him on that golf course, and he thanked me, not facetiously because we liked each other. He thanked me for letting him go because he would have never made the move on his own. And what I realize is keeping someone in a position, forget about your own reasonable profit motives, because if there's not profit, you can't help more people. You can't hire more people. You can't help more clients. So profit's important. But when you keep somebody in a position where they're not successful, you're really not doing anything for their psyche, because this fellow had to be feeling terrible every day when he got up and feeling a little bit like a failure. And in short order, he's on the golf course all the time, making fabulous money and giving his wife and family what he'd, to feel more like a man, he should give them, etc. So it's not doing anyone a favor hanging on to him if they're not doing it for themselves, for their own feeling of success.
Yeah, a lot of people who hire, especially in a startup business, I'm the guy, or it's a fairly tight knit, and you make hiring decisions. You don't want to say to yourself you're wrong. I was wrong on that. So you make excuses for people. And as soon as you start making excuses for people, that's time to let them go. And for entrepreneurs that are out there that are, building a team, you're going to make a mistake, and don't beat yourself up about it. As soon as you start making excuses. And, in Canada, we've got, a lot of different severance laws and whatnot. And you learn. You write the check, you pay them out, and away you go. And move on. You're way better. Your organization is way better, by doing that than it is hanging on to, a poor fit or someone who's not doing the job. And yep, you made a mistake. It's your fault. Take the lumps and move on. So that's number one. Hire slow, fire fast. Again, this is a lesson as an entrepreneur. You have to be, as an entrepreneur, you have to be good with someone doing the job differently than you would have done it. And you have to be open to the way in which they're doing it is better than the way in which you would have done it. If you're not open to those two things, you might as well not start, because you can't scale your business without people, and they're going to be doing something different. And if you want them to do it the way that you wanted to do it, then you better fucking do it. And if you're going to do it and micromanage them, then you know what? They're not going to stick around. So you have to be okay with someone doing a job poorer than you would have done it. You have to be okay with that, because they're not going to have the same passion and motivation and everything that you bring to the table as an entrepreneur and the person that created it. So if you're not open to that, then you're not going to be able to attract talent. You're not going to be able to give them autonomy. And if you are the ubiquitous control freak entrepreneur, which there are too many of, but if you're that person, that's going to be tough. So be open to people doing the job differently than you would have done it, but also be open to the way in which they do it to be better than how you saw it to do it, right? So that's number 2. Number 3, replace thyself. I said to a contractor one day, I said, as a good contractor, you should work yourself out of a job. If you are a contractor and you create reliance, if I have to rely on you permanently, you're not the right person for the job. And that holds true for a CEO and entrepreneur. Your last job, your first job and your last job is to replace thyself. It is highly irregular for the entrepreneur to be able to go all the way through, the 22 years that we've been in business without replacing yourself. And, I've replaced myself a couple of times. I have a partner, Robert Varga, who is now president and CEO of our operations company, Insurance Insight Incorporated, which is a registered insurance brokerage here in the Toronto region. And Robert's created, massive gains in the company as it relates to culture, team, and those types of things. I'm not that guy, and Rob is, and I had to replace myself with Rob, and I have to be able to put my trust in that. So those are the 3, I think those were the 3 big lessons that I've learned and looking back. And I think that they apply for anyone and everyone who starts their own business. And I think that, that would apply to Jack Welch or anyone else, a big CEO. If a company can't run without you, then you've not done your job.
Jack Welch from Alec Baldwin's Idol in 30 Rock.
There you go. Cheers to that. You don't mind if I drink wine during our show, right? Like, it's okay.
Well, you're Canadian, so that probably started around 11 this morning. I understand.
No, that's cannabis here. Only kidding.
Finally, and I'm really sorry to keep you past your 15-minute podcast limit. You sold $900 million in premium with your WALKAWay product. How much have you given back, or what kind of debt have you gotten people out of related to that?
Oh my God. We've probably protected $125 billion worth of car loans in the world.
Oh my God.
We've distributed in Australia. We've been in the US for many years now, albeit we have a challenge in the US. Oddly enough, our product doesn't get, I don't know if it's line 4 or line 5 or line 4 approval to be financed, the premium financed so line 4 approval. We've never received line 4 approval in the United States. So our program is largely, regional, promotional, times here and there where a dealer will go on for a promotional period. So it's very spotty. We've sold $30 million worth of premium in Puerto Rico, oddly enough. Yeah, we've protected $125 billion worth of auto loans and leases worldwide.
So let me just clarify. When you say line 4 approval, does this mean that the bank gives the dealer an approval on that customer, will lend $42,500 on that customer against that car, not to exceed 110% of loan value, et cetera? But then addition, we'll let them buy other products on top of that approval. Okay, got it. All right.
You got it. And the WALKAWay premium. So understand, WALKAWay starts as a complimentary 12-month paid for by the dealer, the OEM financial institution. And then you can, in Canada and other parts of the world, you can enter the business office and the business manager says, "Hey, Jeff, did your sales rep share with you our 12-month vehicle return program? Our WALKAWay program?" "Oh yeah, they did. That's great. But let me share with you. Let me share with you how that works." And you go through the proposition of how that works. And if you've been in the retail industry before, Now I'm just sharing with you something that we give you. I can build value in that product without you feeling like there's a sales conversation going on. And I can share with you, hey, well, if you lose your job, Jeff, in the first 12 months of your ownership, you can bring the car back and walk away with little or no cost. Lose your driver's license, do this, do that, and here are all the features and how it works. I say, would you like to extend that to the full term of your loan, Jeff? 72 months or 60 months? And if anything happened in the first in 5 years, you can return the car at any time if that, blah, blah, blah. Oh, yeah, sure, that'd be great. The premium to that is X dollars, but in the U.S., financial institutions will not finance that premium.
Will not let you put it in the loan. Now, the $125 billion that you're covering, that means that for the $900 million in premium, if every single person on day one, because obviously halfway into the loan, they only owe about half as much, or, give or take. So if every single person returned their car within a week because they lost their job, you'd be on the hook for $125 billion.
Our underwriters would, but not that's the total value of the loans, Jeff, not the negative equity associated to those loans.
I see. They might owe 40 grand, but you're covering 10 because that's how much negative equity they have. Okay.
Right. And, car dealers love the fact that the customer returns to the dealership. They love the fact that they're getting a used unit that they sold. The customers come back at a tough time. And, as soon as they get their job or whatever happened precipitated their return of the car, you've got that customer as a customer for life once you do that, right? And
Oh, they'll come back.
Yeah, they'll come back. But in terms of claims, I will only share one statistic with you. We, in Canada alone, and remember, Canada's teeny tiny as it relates to the U.S., we're 10% the size of the population in the U.S. We have relieved consumers of over $130 million worth of automotive debt.
That's unbelievable. That's unbelievable. Now, I actually...
So if you'd have to times that by 10, and that's what we do here. I mean, we're 10% of the U.S. You times that by 10. If we were in the U.S. and this story was a U.S. story, it'd be from 130 million to times a factor of 10.
Got it. So this actually has me curious now when you talk about the dealer getting the car back. So here's how the coverage goes. Customer takes delivery of a car. 6 months later, they lose their job. They want to take advantage and walk away from the car, give it back. They have $10,000 negative equity because they still owe $35 on their loan, and the dealer says the car is worth $25, and the insurance pays $10. How do we determine that the dealer made an acceptable offer, which obviously impacts the amount of negative equity you're covering? How do you end up agreeing that they're offering the right amount for the car to keep it?
It is in their dealer agreement that we have a wholesale formula, and it's in the insurance policy so that the insured knows how the vehicle is being formulated, or the vehicle value. And we want to do that because the customer knows, so that, for example, let's say the negative equity is $10,000 and the dealer is evaluating the vehicle and it's $11,000 is the insured loss. But we'd say, hey, dealer, that's outside of our formula. So we produce a formula that uses known wholesale guides, and the dealer sits inside of that formula, and away they go. And that's how we bring the product to market. And that's one of the unique features.
But if the car's been smoked in and you can't get the smoke smell out, and it's got 3 bald tires and it's been hit and painted twice, and it's obviously not good paint work, and it doesn't stay inside of that formula, is the idea that the dealer will end up getting so many back that he'll win on some, lose on some, so he just agrees as part of this package that he'll take them all at that number? Well,
I mean, it's we work with franchise dealerships. For the most part, it's new and used, and it's retail new. We're not working with wholesale or as-is vehicles, so there are some limitations as to where the product and how the product is available. But I mean, 3 bald tires and it's been repainted. We've dealt with some very challenging situations, but it's kind of like such a small percentage of the business that relates to that. So, you have to look at the overall program and how that hangs together. There's always a little bit of hairball when it comes to insurance and insurance claims, but for the most part, we've eliminated most of all of that in the 22 years we've been doing this. And our policy has matured, and we've learned things that we couldn't have anticipated, that we had to basically absorb ourselves. Like, we had to pay, for the dealers had situations that we couldn't have anticipated, so we just took it on the chin and had to pony up and write a check, and that's what you do when you have a product that's new in the business, and that's why we try to protect the intellectual property of what we've done too, is because we've taken it on the chin, and there are situations like that, Jeff. But if the amount of negative equity is more than the policy value, and we have policies that cover up to $25,000 worth of negative equity in Canada. But if the policy doesn't cover the total amount, the customer has to come up with the difference, and we don't think that's an unfair ask. So, if you've got $11,000 worth of negative equity and we're covering $10,000, that's a pretty good deal, don't you think?
Vince Beretta, thank you so much for your time and stories, folks. I hope you enjoy.
Hey, thanks, Jeff. It was a pleasure speaking with you, and look forward to the next time we can get together and see you in leather pants.
This has been Jeff Stearns, Connected Through Cars.